Trump's latest threat toward Iran is not just another political headline. If markets take it seriously, this could very quickly become an oil story, an inflation story, and a rate story all at once. And when those three things begin moving together, stocks, bonds, gold, and the dollar rarely stay calm for long. The real question is not simply what Trump said. The real question is what markets now believe has become more likely because of what he said. Welcome to Vale Macro. This channel is about decoding the real economic meaning behind major events, political signals, and market-moving headlines. The goal here is not to repeat the news. The goal is to understand what the news may actually be changing underneath. And this story matters because it shows exactly how one statement, one post, or one threat can change the way markets price risk long before anything official happens in the real economy. Trump recently posted a direct threat aimed at Iranian infrastructure and tied it to the Strait of Hormuz. On the surface, this looks like a geopolitical provocation. But for markets, it is much more than that. Markets do not hear a statement like this as mere rhetoric. They hear it as a change in probabilities. They hear it as a possible shift in the odds of escalation, disruption, energy stress, inflation pressure, and central bank hesitation. That is where the macro story begins. This is one of the most important ideas in all of market analysis. Markets do not wait for confirmed damage. Markets move when expectations begin to change. They move when the future looks even slightly different from what investors believed just a few hours earlier. That is why one post can matter. That is why one speech can matter. That is why one line from a president, a central banker, or a major policymaker can move billions of dollars in a matter of minutes. The Strait of Hormuz matters because it is one of the most sensitive energy choke points in the world. A very large share of globally traded oil passes through that narrow waterway. So when rhetoric around Iran intensifies, markets do not need to wait for actual physical disruption to become worried. They only need to believe that the probability of disruption has risen. And once that probability rises, traders begin adding risk premium into oil prices. That is how the move starts. This is a point that is often misunderstood. People sometimes think oil only moves when supply is physically interrupted. That is not true. Oil can move because of expected supply risk, not just actual supply loss. If markets begin to think that a conflict could threaten the flow of crude, damage infrastructure, or complicate shipping and insurance, then prices can move well before any tanker stops, well before any pipeline is hit, and well before any official statement confirms a supply problem. Markets price the possibility first. That is why a post like this matters beyond politics. It changes the market's map of future risk. It asks traders, investors, and policymakers to reconsider a set of assumptions they may have been relying on. Maybe they believed that regional tensions would remain contained. Maybe they believed that energy supply would remain stable. Maybe they believed inflation was on a smoother path lower. Maybe they believed central banks would have more room to cut rates later in the year. A new geopolitical threat can unsettle all of those assumptions at once. And once oil enters the story, inflation enters the story almost immediately. Oil is not just another commodity. It sits at the center of transportation, shipping, logistics, production, and broader cost structures throughout the global economy. When crude rises sharply, it does not stay isolated. It begins moving through freight costs, industrial costs, airline costs, trucking costs, and eventually consumer prices. Sometimes that pass-through is fast. Sometimes it is delayed. But the important point for markets is that the inflation risk returns to the conversation very quickly. And that is where the second layer of the market reaction begins. If oil rises enough to revive inflation fears, then markets have to ask another question. What does this mean for interest rates? What does this mean for the Federal Reserve, for the European Central Bank, and for other central banks that may have been hoping for a cleaner disinflation trend? If energy shocks begin pushing inflation expectations higher again, then the room for rate cuts may shrink. And if the room for rate cuts shrinks, then a lot of asset pricing has to be reconsidered. This is why one geopolitical event can become a multi-asset event. It starts with rhetoric. Then it moves into oil. Then it moves into inflation expectations. Then it moves into rate expectations. Then it spreads into stocks, bonds, gold, and currencies. What began as a political threat quickly becomes a macro chain reaction. Let's break that chain down more clearly. First, there is the geopolitical trigger, a threat against Iran, especially one tied to infrastructure and the Strait of Hormuz, immediately raises the possibility of energy disruption. Second, that possibility raises the chance of higher oil prices, even if nothing physical has happened yet. Third, higher oil prices increase inflation concern, because energy still matters enormously for the broader cost structure of the global economy. Fourth, if inflation concern rises, then markets become less confident that central banks will be able to ease policy comfortably. Fifth, if rate cut expectations weaken, then risk assets have a harder time holding up, especially if valuations were already rich or positioning was already complacent. That is how one political signal can cascade across the entire market. Now let's look at the asset classes one by one. The first and most obvious market to watch is crude oil. This is the cleanest and fastest transmission channel. When a market hears Iran, Hormuz, and infrastructure threat in the same story, oil traders do not ignore it. They begin evaluating whether the balance of risk has changed. Even if they do not expect immediate disruption, they may still demand a higher risk premium. In other words, they may still require a higher price to reflect the uncertainty. The second market to watch is gold. Gold tends to respond when trust weakens, when uncertainty rises, and when investors begin thinking less in terms of growth and more in terms of protection. If the geopolitical story starts spreading beyond oil into a broader fear narrative, gold can become a major beneficiary. Not because gold fixes the problem, but because it often becomes a parking place for capital when political and macro confidence deteriorate. The third market to watch is the US dollar. This part is very important. In many global stress episodes, the dollar strengthens, not necessarily because the U.S. economy looks perfect, but because the dollar remains central to global liquidity and risk management. If geopolitical fear rises and investors want liquidity, safety, and flexibility, capital can flow toward the dollar. That can tighten financial conditions even further, especially for other countries, emerging markets, and dollar-sensitive borrowers. The fourth market to watch is bonds. This one is more complicated because bonds can react in different ways depending on which force dominates. If investors think the main effect is slower growth and more fear, bonds can rally as money moves into safety. But if investors think the main effect is higher oil, stickier inflation, and delayed rate cuts, yields can rise instead. That is why bond market interpretation is so important. It tells you whether markets see this primarily as a growth shock, an inflation shock, or a mixture of both. The fifth market is equities. Stocks usually dislike a combination of higher uncertainty, higher energy costs, and weaker confidence in rate cuts. That does not mean every stock falls immediately, and it does not mean every geopolitical scare becomes a lasting bear market event. But it does mean the environment becomes less friendly. Valuations become more vulnerable. Earnings expectations become more fragile. Sector leadership can shift. The tone of the market changes. This is why the most important thing to understand is not the headline alone. It is the market interpretation of the headline. Headlines tell you what was said. Markets tell you what investors think it means. And that gap is where the real macro story usually begins. When people hear a story like this, one common mistake is to think in extremes. Either they assume it is nothing but political theater, or they assume it guarantees a full-blown crisis. Markets usually do something more nuanced than that. They begin by repricing probabilities. They do not need certainty. They do not need a guaranteed outcome. They only need to believe that the odds of a bad outcome have increased enough to justify repositioning. That means this story does not have to become a real supply crisis in order to matter. It only has to become more credible as a risk. And once it becomes more credible as a risk, pricing changes can start appearing across multiple markets. There are really two broad scenarios here. The first scenario is that this remains mostly rhetorical. In that case, crude may rise for a short period, investors may temporarily move towards safety, and then markets may calm down if no meaningful escalation follows. This kind of pattern happens often. A geopolitical headline causes a burst of repricing, and then the move fades when traders realize the rhetoric is not becoming operational. The second scenario is that the rhetoric becomes part of a broader escalation pattern. In that case, The market may begin treating it less as noise and more as a credible precursor to something more serious. If that happens, oil can stay elevated longer, inflation concerns can become more persistent, and rate expectations can shift more meaningfully. That is when the story stops being a short-term political shock and starts becoming a real macro regime issue. So what should investors actually watch next? The first thing is oil itself. Not just whether it spikes for a few hours, but whether the move holds, broadens, and starts affecting how inflation-sensitive assets trade. The second thing is inflation expectations and rate cut probabilities. If oil rises, but markets still fully believe aggressive easing is coming, then the macro effect may remain limited. But if oil rises and markets begin reducing their confidence in rate cuts, then the story becomes much bigger. The third thing is the dollar. If the dollar strengthens at the same time, that tells you global capital may be shifting towards safety and liquidity, which can tighten the financial backdrop further. The fourth thing is gold. If gold begins moving decisively higher, that often tells you trust and uncertainty are becoming more central to the story. The fifth thing is whether the situation remains verbal or becomes operational. That distinction matters enormously. Markets react one way to threats. They react much more aggressively to physical evidence of escalation. There is also a deeper lesson here that matters beyond this specific story. Markets are not moved only by data. They are also moved by language, belief, interpretation, and confidence. That is why political speeches matter. That is why central bank language matters. That is why warnings, threats, and shifts in tone can matter before any official number changes. Numbers matter, of course. Inflation data matters. Growth data matters. Jobs data matters. But before the hard data reflects the shift, markets often move on the signal first. And that is exactly what makes macro analysis so valuable. The point is not to predict every headline. The point is to understand the transmission mechanism. If a story touches energy, it may touch inflation. If it touches inflation, it may touch rates. If it touches rates, it may touch valuations, currencies, and risk appetite. The market is a network of connected expectations. Once you see the chain clearly, headlines stop looking random. That is how this Trump-Iran story should be understood. It is not only about the political language. It is about what that language may force markets to consider. A higher chance of energy stress, a higher chance of inflation pressure, a lower chance of easy policy, a higher chance of volatility across major asset classes. And once those probabilities shift, capital moves. This is one of the most important ideas in all of market analysis. Markets do not wait for confirmed damage. Markets move when expectations begin to change. They move when the future looks even slightly different from what investors believed just a few hours earlier. That is why one post can matter. That is why one speech can matter. That is why one line from a president, a central banker, or a major policymaker can move billions of dollars in a matter of minutes. That is why one post can matter. That is why one speech can matter. That is why one threat can matter. Not because it changes the world instantly, but because it changes how investors price the world that may be coming next. If this story remains rhetorical, the move may fade. If it becomes part of a larger escalation path, the move may deepen. But either way, the market reaction itself is already useful information. It tells you what investors are becoming more sensitive to. It tells you what the system is worried about. It tells you which assumptions are becoming less stable. This is why the most important thing to understand is not the headline alone. It is the market interpretation of the headline. Headlines tell you what was said. Markets tell you what investors think it means. And that gap is where the real macro story usually begins. If you want daily breakdowns of major events and what they could mean for oil, inflation, rates, and your money, subscribe to Vale Macro. This channel is not about repeating the news. It is about decoding what the news may actually be changing underneath. And if you want, leave a comment below telling me what you want me to break down next. Oil, inflation, the Fed, gold, or the dollar. I'll see you in the next one. Welcome to Vale Macro. This channel is about decoding the real economic meaning behind major events, political signals, and market-moving headlines. The goal here is not to repeat the news. The goal is to understand what the news may actually be changing underneath. And this story matters because it shows exactly how one statement, one post, or one threat can change the way markets price risk long before anything official happens in the real economy. If you want daily breakdowns of major events and what they can mean for oil, inflation, rates, and your money, subscribe to Vale Macro. This channel is not about repeating the news. It is about decoding what the news may actually be changing underneath. And if you want, leave a comment below telling me what you want me to break down next. Oil, inflation, the Fed, gold, or the dollar. I'll see you in the next one.